It's November 14th, JLD here, and welcome to MSTR Today and the Treasury Titans. And listen, it's Friday, November 14th, 2025, and it's an absolute bloodbath. We don't need to pretend otherwise. This is where I just sit tight and hodl. I go for walks, I hang outside, I get off Twitter. I've had to do this multiple times throughout my MSTR journey, and each time I was really rewarded for hodling. Doesn't sound like something we want to hear right now, but it's just the reality. And the reality also is this market sucks. It absolutely sucks. I think it sucks. You think it sucks. Everybody thinks it sucks, except for potentially the bears out there. Anyways, this is going to be a slightly different video than usual because you don't need to hear from some posts about this and that today. What I really believe that we all need is a little Michael Saylor keynote. This 58-minute keynote was an absolute masterclass. If you've already listened to it, listen to it again because you will walk away feeling so much better about Bitcoin, about your strategy position. If you haven't listened to it, please listen to it, but also watch it because the graphs and the charts are absolutely stunning. You will feel better by the end of this video if you are a Bitcoin bull. If you are a strategy bull, you will feel better, period. End of story. So enough of me yapping away. Michael Saylor, just take it away.
And what a year it's been. This is a very pivotal year, I think, in the formation of the digital assets industry. They say the two most important days of your life are the day you're born and then the day you figure out why. And I think the extraordinary thing that's happened over the past 12 months is I think a lot of us figured out why. Why are we in this industry? And I'm delighted to be with you today because I want to share my why. And my why is going to cover three pretty profound topics. The formation of a new asset class called digital capital, the formation of a new business model, the digital treasury business model, and the formation of a new asset class, digital credit. And I think 12 months ago, we knew that digital assets were auspicious and we were all very bullish on Bitcoin. But I really think the past 12 months have provided extraordinary clarity about these three topics. So first I'll talk about digital capital. I think the emergent consensus in the world over the past 12 months is Bitcoin is digital capital. There were some pretty pivotal events. The Red Sweep was a pivotal event. The appointment of 12 pro-Bitcoin cabinet members was a pivotal event. When the president said we're going to be the superpower, the Bitcoin superpower, that was a critical event. When David Sachs said Bitcoin is digital gold, a digital commodity, the global commodity, it's March of 2025, when he went on television to assert that Bitcoin was special and recognized for its commodity status. That was a pivotal event. And we bandy about, this phrase, digital gold, and people talk about, is it just a store of value? Can it be successful if it's only a store of value? Well, there's a theme to that, which is the bug is the feature. And I think that the humbling epiphany of the past 12 months is every criticism and every bug in these asset classes, in this industry, in the treasury business model has turned out to be the feature. And here, store of value means capital. Gold is store of value. And if you are a store of value, and if you are digital gold, and you emerge as digital capital, then that is a profound paradigm shift for the entire economic world. So why is Bitcoin digital capital? Well, the politicians say it's digital capital. The banks have embraced it as digital capital. Now we actually have JP Morgan expressing support for the asset class. We have the head of Charles Schwab that's announced that they're going to custody Bitcoin. They're going to let you trade it. They're going to extend credit against it. They're going to let you deposit it and withdraw it in the first half of 2026. That's extraordinary. So what you see now is I, 12 months ago, I couldn't get a loan against any kind of Bitcoin posted as collateral from any major bank in the United States. Right now, Bitcoin is creditworthy collateral at Merrill Lynch, at JP Morgan, at Charles Schwab, at Texas Capital Bank, at BNY Mellon, at Wells Fargo. And so there's probably a few that I've skipped. I think Citi has just announced that they're going to start to custody and bank Bitcoin the first half of next year. So we have basically progressed through the unthinkable. We've gone from a toxic asset class that the administration was against and the banking industry did not acknowledge, to an emerging asset class that's getting the grudging respect of half of the major banks in the United States, and it's spreading like wildfire. And these are the most conservative, risk-averse organizations in the world, and if they go and do a 180 in just 12 months, that's pretty extraordinary. And if half of them embrace this asset within 36 months, I think that's light speed. So you've seen the banks embracing Bitcoin. Now you're seeing Wall Street. Of course, we all know the story of the success of IBIT, the most successful ETF in the history of Wall Street. I've tracked it pretty closely. What's interesting, of course, is it went from nothing to about $100 billion in less than 2 years. But also, if you look at the emergence of the derivatives market on top of IBIT, it went from nothing to $10 billion to $50 billion. And if you look at the liquidity, it went from nothing to trading $4 to $5 billion a day. It's really quite extraordinary. Public companies have embraced this asset. If it's going to be digital capital, someone's got to be able to capitalize on it. There was one company that capitalized on it in the summer of 2020, and then there was two, and then there was three, and we thought that was kind of cool. And then there were 20 and 30. There were maybe 30 at the beginning, the middle of 24, 60 toward the end of the year, and we've gone from 60 to more than 200 in the year 2025. 200 publicly listed companies, up from 60 in 12 months, is quite a bit of progress in a single year. So this is an extraordinary dynamic. And of course, the marketplace itself, right? What we see is 700 million crypto believers. The crypto industry tipped the election last year. It's becoming the most powerful, if not the most powerful, political movement in the country, and it's global phenomena. And if you're going to be global digital capital, then you probably want to rest on liquidity. So you're staring at $60 billion a day of liquidity. But on Friday, I think we had $100 billion trading. So it's an emergent, powerful asset. It's electrically powerful. It's computationally powerful. It's economically powerful. And it's politically powerful. And it's never been more powerful. So that observation, Bitcoin is digital capital, is key. We are capitalists. The capital assets of the 20th century: equity capital, real estate capital, credit-based capital. Most of the world thinks private equity, public equity, and real estate is primary capital. The emergence of digital capital is pretty profound because it represents an alternative to people who don't perhaps want to store all their wealth in real estate. As I've said before, there's really no real estate in Africa you probably want to put your family savings into for the next 100 years. There are lots of parts of the world where people just don't want to store their economic energy for long periods of time. So the emergence of digital capital is a global phenomenon. It's also a political phenomenon. It's also a technical phenomena. And of course, if you pair the emergence of digital capital with the emergence of digital intelligence, you can imagine that in a world with a billion AIs talking to a billion AIs a billion times a minute, they're not going to have a lot of patience for 20th century ways of doing things. They're not going to buy sports teams. They're not going to buy fiat sovereign debt capital. They're not going to store their money in cash. They're not going to trade gold. They're not going to want to store their capital in buildings or cross-trade commercial real estate. They're certainly not going to be comfortable with securities and all of the human and legal and political restrictions that come with them. So the emergence of digital capital at the same time as we have an emergence of digital intelligence is, maybe it's a coincidence, but maybe it isn't a coincidence. Maybe it's an inevitability. So the second point I want to focus on is the emergence of the treasury model, of a digital treasury model. What is it? A treasury company is a company that sells securities to buy a commodity that it then capitalizes on and then issues credit against the commodity. So if you sell securities, raise capital, and then issue credit against the capital, you've created a treasury company. There traditionally haven't been a lot of treasury companies because the SEC 40 Act prohibited publicly traded companies in the United States from capitalizing on securities portfolios. Everything that I'm going to describe, you could do with the S&P index or a portfolio of Magnificent 7 stock, except for the fact that regulations in 1940 put in place by the United States make it illegal. And so because you could never have more than 40% of your liquid assets sitting in securities, you find Warren Buffett's got to continually trim his position in Apple stock. He's got to sell his securities. He's always got to keep 60% or more of his liquid assets in treasury bills. And it turns out that most of these mathematical methods don't make any sense if you're using sovereign debt as your capital asset for economic reasons. So we inadvertently discovered a new business model. There's insurance companies, there's banks, there's all sorts of business models. This is a treasury business model. And how does it work? We sell equity, we sell credit, we sweep cash flows, we buy Bitcoin. We've done it 85 times. We found ourselves with about 3.1% of all the Bitcoin in the world. We spent $48 billion to buy it. It changes value every day, plus or minus a few $1 billion. Doesn't bother me, it bothers other people. I rather like it. I enjoy it. We've gone from an irrelevant company to the 5th largest treasury in the S&P index. You can see the chart. We'll be the number 2 in the next 12 to 24 months. I expect we'll be the number 1 in 4 to 8 years. There's only one company on this chart other than ours that has a practice of accumulating capital, and that's Berkshire Hathaway. Every other company on this chart has a practice of surrendering capital. And so one of the big ideas in the treasury model is instead of surrendering capital enthusiastically as fast as you can and bragging about it, you might want to keep the capital. Every big bank, every time they have a good quarter, they increase their dividend and increase their buyback as though that's an accomplishment. Every big tech company increases their dividend, increases their buyback as though it's an accomplishment. It's not an accomplishment to surrender your money, right? If you walked into your dining room on Thanksgiving and told your family that your idea to improve the family was you're going to give away all the family's money. That way we won't have a volatile balance sheet. It's not good for the family, right? I think intuitively you know that it's not a good idea for you to give away your money. And you know it's not a good idea for your family to give away your money. But somehow, somewhere along the line, the conventional wisdom in corporate finance is that money is toxic, capital is bad, and the most shareholder-friendly thing you can do is decapitalize the company by throwing all the money out. Now, of course, the irony is the best-run companies in the world are in the business of getting rid of money. And that leaves the investors to figure out what to do with the money that's being surrendered by the well-run companies. And there's a certain irony to it all. It comes about because they're all capitalized on the wrong asset.
Fire Nation, when you want more for your business, more privacy, more guidance, more success, it all starts with Northwest Registered Agents. These legends have been helping entrepreneurs launch and grow their businesses for nearly 30 years. They're the largest registered agent and LLC service in the U.S. with over 1,500 corporate guides, real people who know your state's laws and actually care about helping you win. With Northwest, you can build your complete business identity, everything from what your customers see to what they don't, operating agreements, meeting minutes, compliance paperwork, and more. You'll get thousands of free resources, lawyer drafted forms, and step-by-step guides all in one place, and you don't even need to create an account to access them. Best part, privacy is automatic. Northwest never sells your data and handles everything in-house. Don't wait, protect your privacy, build your brand, and get your complete business identity in just 10 clicks and 10 minutes. Visit www.northwestregisteredagent.com/JLD free and start building something amazing. Get more with Northwest Registered Agent at www.northwestregisteredagent.com/JLD free. Senator Cynthia Lummis recently announced that funding for a U.S. strategic Bitcoin reserve can start anytime. This is a massive step forward for a strategic crypto stockpile, and no surprise, was soon followed by a new all-time high for Bitcoin. If you're looking to buy more Bitcoin, BitIRA can help. In fact, BitIRA will help you convert an existing IRA or 401k into Bitcoin. This also allows you to buy Bitcoin using pre-tax funds, then continue to invest in it over time as you do any other retirement account. And if you want, you can even add XRP, Ethereum, or other cryptos. BitIRA protects your assets with end-to-end insurance, highly secure storage, multi-encryption, and is registered with the US government. Your IRA is fully IRS compliant. Best of all, you can trade crypto within your retirement account without incurring taxes on any buys or sells. Just go to bitira.com/JLD and request a free info guide. Once you do that and open your IRA, you'll get a free ledger. Think about this. In March, President Trump signed an executive order for the Treasury to manage 200,000 Bitcoin as the foundation for a reserve. That's just the foundation. Go to bitira.com/JLD to open a tax-sheltered IRA in Bitcoin.
You can see here, in the last 5 years, the cost of capital is 14%. It's the S&P index. Turns out the gold is tracking it. You have two interesting capital assets: metallic capital, gold; equity capital, the S&P index. 14%. That's your hurdle rate. Money markets pay you 3%. Therefore, you're destroying 11% of your treasury assets every year that you hold money markets. Bonds are minus 4%. That's how you bankrupt your bank. The Mag 7's double that number. Bitcoin's double that number. Our company outperformed Bitcoin in the time frame. If your company is capitalized on an asset which underperforms the S&P, then you're negatively polarized to capital. It's toxic to you. So you're going to throw it away as the rational thing. If you're capitalized on a product like Bitcoin that outperforms the S&P, you're positively polarized to capital. You attract money. In fact, the more money you raise, the more profitable you become, the more shareholder value you create. It's a very simple idea. Flip the polarity from negative to positive, and then you just get stronger every single year, and you'll get more powerful. But as you can see, right, the reason that you can't capitalize on the Mag 7 is the SEC 40 Act. And you can't capitalize on the S&P index because the SEC 40 Act. I guess in theory, you could capitalize on gold. Interestingly enough, no public company has really done that. And the point that I make to the gold bugs is even the gold miners don't do that. And if the gold miners aren't doing that, then there must be an issue. I don't know what the issue is, but what I do think is the general tendency of corporations is you throw away your money to the investors, and the investors buy the index, and that's how they keep their economic wealth intact. And that's good for the investor, right? That's why Harvard Endowment and Yale and Harvard and all of these large institutions, that's why they have a 500-year life expectancy. They just buy a capital asset like real estate or equity. And the reason that your favorite company lives for 5 or 10 or 15 years and goes bankrupt is because they don't have any assets. right? It's like, again, I've said before, they're like type 1 diabetics, right? They can't store energy. Bitcoin is insulin. It's insulin to the type 1 diabetic, right? If you're a company, you need Bitcoin. It's like your insulin. All of a sudden, you can store economic energy. You're not doomed to decapitalize yourself. Our company's raised a lot of money. We raised, a ton of money via equity issuance, a lot of money by bonds, and in the last 12 months, we've really rotated to raising capital via preferred stocks and preferred credit instruments, and that has taken off. Now, what is the Treasury business model? We're really financial engineers, right? We engage in financial structuring or structuring we're a structured finance company, if you will. And what you can see here is the raw asset is Bitcoin. It's got a 51% ARR and a 43 vol over the past 30 days. If what you wanted was that, you could just buy it. But what we've done is we strip the volatility and the risk off of the asset. So we strip a bunch off with Strike down to 29, then 18, then 15. And Stretch, we stripped it down to 8% in the last 12 weeks. Stretch today, it's targeted at 100. It traded between 96 cents and 107 cents, but it's down to trading plus or minus 4 cents or 5 cents. If that trend continues, the vol on Stretch will go to 1 or 2. And so what we're really doing is stripping the volatility off of the pure economic asset. There's conservation of energy in the universe. Where does the volatility go? It goes to the equity. If I actually convert 50% a year performance into 11% performance, where's the extra performance go? Goes to the equity. So what we're doing is fairly elementary. We're just stripping the performance and stripping the volatility and stripping the risk, and the extra risk, the extra performance, the extra volatility goes to the equity. And that's why a business that has $70 billion in digital capital can create $3 billion of very, very low volatility credit. It's not that different, again, to take a barrel of crude oil and you take crude oil, if you distill it to the highest, most distilled form, you have kerosene. Kerosene is jet fuel. Kerosene is rocket fuel. Now I'm going to make a joke. If you study the history of science, it's full of examples of people that saw breakthrough technology, but they used the technology the wrong way because they were conventional thinkers. The idiom is repaving cow paths. It's like you invent concrete and you could create a 6-lane superhighway and the car could go 90 miles an hour. But instead, I take the concrete and then I put it over a cow path that was meant for a cow that moves 4 miles an hour. And now I've got a paved cow path where cows can now move 4.5 miles an hour. You got no benefit from the technology because you used it the wrong way. Now I'm going to give you an example here. John D. Rockefeller, distills kerosene, and you're in the horse and buggy business. So what do? Well, you create a kerosene lamp, and you put a kerosene lamp in the back of the horse and buggy so that your customers can travel across the country by horse and buggy with a kerosene lamp and read a book. Or you put a kerosene heater in the back of the horse and buggy, and you brag that now you've got a warmed horse and buggy, and you won't be cold while you're in the horse and buggy. But a dude like Ford comes along and thinks, well, maybe we'll just create an automobile and we'll drive with gasoline. Or maybe Boeing comes along and creates an airplane and we just fly across the country. So there's a compelling thing to do with the kerosene, like rockets and jets. And there's gasoline and there's cars. But there's also the trivial application of the technology, which just makes the horse and buggy 1% better. And yet you'll have the greatest business people of the era made all their money with horse and buggies, and they're going to grab the kerosene, put a kerosene lamp in the back of the buggy, and they're going to declare that they've used the technology for the good of their shareholders. And what I would say here is you just have to think different, and you have to think much bigger with regard to what you can accomplish here with this technique. What we do is we accrete Bitcoin per share, right? So our equity investors want more Bitcoin per share. We started with 56,000 Satoshis a share, and we added every single year. We added about 74% more last year and 26% more this year. There's a lot of ways to do it. You can sell equity, you can sell bonds, you can sell preferred stocks, you can sweep cash flows. This is a snapshot of the company's balance sheet. In essence, we're 1.1 levered, we're 1.3 times amplified, and we have 84 years of dividend. When Lehman got in trouble, they were 30x levered. And then they went to 50x levered. At one point, they had $15 billion of equity and $750 billion of assets, right? So I get preached to a lot by finance bros that want to tell me don't get too levered. But what I want to point out is we're not even 2x levered. And literally the leverage is going to 1. That debt is going to go away. So the interesting thing to do here, of course, is to use credit that is equity to amplify your performance, because if you do that, you can do it without credit risk. And it's very interesting. Our future is in credit issuance, right? What I said, the day you were born and the day you figure out why. Why are we here? We're here to sell digital credit. And the product is the credit. And so we just got a credit rating from the S&P. We're the first digital treasury company to get a credit rating. It's pretty much the worst credit rating you could justify. We're starting at the bottom and we're crawling up. And it's predicated upon the Basel Accord, which it suggests that Bitcoin is worth zero. It's zero capital. So you have a banking establishment that values Bitcoin as zero, but you have the marketplace that thinks it's worth $70 billion. Over time, we will rectify that, just like with accounting standards, we were able to rectify that. And as that gets improved, then our credit ratings will move up. But the significance of a B credit rating is that instead of having access to 2.8 trillion worth of capital, you'll now have access to another 4.9 trillion. So we 3x the addressable market for credit instruments that we're selling. And the most important thing is to allow fixed income investors and insurance companies to allocate to that part of their portfolio. So we thought that was auspicious. Our ambition is just to continue to improve the credit rating until we're an investment grade issuer of credit. And that takes me to the product, right? The product is digital credit, right? Did it exist a year ago? No. We invented it. Necessity is the mother of invention. Why do we invent digital credit? Because traditional bonds are too risky. We tried traditional bonds. We tried asset-backed borrowing. We found that either the bond market wasn't large enough or wasn't stable enough. And pairing traditional short-duration credit instruments like bonds with an asset like Bitcoin, which is highly volatile, creates a very dangerous situation where you might get forced liquidated, or you might get yourself into a credit crisis. That's not good for the equity. And so over time, right, this is the conundrum that every financier has, right? How do you go bankrupt? You lend long, you borrow short, right? A bank has overnight deposits and puts out 30-year money, and then people want their deposits back, and you can't call the loans, and so you get a run on the bank. When Lehman went out of business, they were borrowing $700 billion for 15 days, and then they were invested in mortgage-backed securities and real estate with a 5, 10, 20-year duration. So obviously, you don't want to mismatch your durations. If your goal is to buy an asset, what is Bitcoin? Bitcoin is a 10-year duration asset. If you're going to buy it, a normal time frame would be 10 years, 120 months. So what you want is a duration on your liabilities that is comparable to that duration of Bitcoin. So how do you get to 10-year duration money? You can't do it with 5-year loans. So we started thinking that what we'd like is to get 10 to 20-year duration, and the way to get that is with preferred equity. And so we went to the market and we thought we're going to sell preferred equity, and we found that the market wants a higher dividend yield for preferred equity than for bonds. And our first reaction was, oh, that's bad, that's a bug. And then after a while, we realized that's actually a feature. If we're paying 200 basis points more than we thought we should pay, then our credit just became the highest yielding credit in the world. And when you flip it from a bug to a feature, then you start to see something different, which is the credit that we issued from 2020 to 2024 was tactical credit in order to amplify the equity. We were trying to, the product was the equity, and the credit was the tactic. And what happened in the last 12 months is an inversion of the business model, where we realized that the credit is the product and the equity is the afterthought. The equity follows from the credit. And the real product is, what if I gave 10% dividend yield to 1 billion people tax deferred and stripped the risk off it? Well, that's a product. That's a product that would appeal to everybody, but maybe more interesting, that might be the best product in the world. Say that again. That might be the best product in the world. If you can give someone 600 to 800% of additional yield over the risk-free rate in a non-volatile instrument in the currency of their choice, you've created maybe the perfect product, because that's what everybody wants.
All right. Hope you enjoyed some Michael Saylor wisdom today. I hope you're feeling a little bit better. We'll pause it here and pick up the second half of this presentation tomorrow. I will put the link in the show notes if you want to just rip through the rest of this presentation today. No worries on that. But all I've got to say is hang in there.
What's the second best? There is no second best.